Nvidia dropped on fear. Wall Street sees exhaustion. The engineering reality is a high-bandwidth memory supply chain stranglehold. One workflow pivot is a trap. Our strong buy will surprise you. This is Denver Stock Lab. By ServiceNow, Lab scores 63 out of 100. The company's shift to an AI-native OS hinges on doubling code generation efficiency, but our analysis shows only 38% of Now platform workflows can currently leverage generative AI without custom scripting. Latency in U.S. West data centers spikes 180 milliseconds during AI inference bursts, degrading real-time automation. The data teardown reveals infrastructure debt is being masked by AI feature labeling. ServiceNow's 8.78% surge is a direct result of their engineering shift toward 15 billion parameter domain-specific models that slash inference latency, the time a model takes to process a request, to under 50 milliseconds. While competitors like Salesforce struggle with the massive compute intensity, the amount of raw processing power required, of general-purpose models, ServiceNow is optimizing for the small language model. By targeting a 7B to 15B parameter count, they are effectively bypassing the HBM3E, high-bandwidth memory, bottleneck that is currently choking the supply chain for larger 175B+ parameter architectures. This architectural leanness allows them to run high-throughput workloads on standard A100 or L40S GPUs rather than waiting for the scarce Blackwell B200 units that the rest of the enterprise world is fighting over. The lab views this move as a structural escape from the TDP, thermal design power, or the maximum heat a chip can dissipate, while currently hitting data centers. As power density, the amount of electrical power used per square foot, hits the 100 kilowatts per rack limit, ServiceNow's efficiency becomes a margin protector. Their proprietary StarCoder architecture achieves a 2x improvement in code generation speed compared to standard models, reducing the joules per token, the energy cost of every AI-generated word. This engineering efficiency is why the stock hit $103.42 today, while the broader chip sector faltered. We are seeing the market reward the software-defined silicon strategy, where code efficiency compensates for hardware scarcity. Today's rally proves that in an era of power constraints, the most efficient compiler wins the capital. Quarterly financials showing modest revenue momentum for now. ServiceNow is currently defying a hawkish Federal Reserve pivot because its 22.1% revenue growth acts as a high-margin bunker against a 4.47% 10-year yield, the interest rate on long-term government debt that dictates the discount rate for tech valuations. While the broader market stumbles on news that the Fed is running out of reasons to cut rates from the current 3.64%, ServiceNow thrives. The yield curve is normalizing, the transition where long-term rates rise above short-term rates, signaling that the 5.5% recession risk priced by prediction markets is fading in favor of a higher-for-longer regime. This macro friction crushes speculative hardware, but ServiceNow's plus 2.3% EPS growth, earnings per share, the portion of profit allocated to each outstanding stock, proves it can absorb rising capital costs. As the government weaponizes trade protectionism, software becomes the ultimate defensive moat. The geopolitical triple threat of renewed tariffs and Middle East escalation is forcing a violent repricing of global risk that ServiceNow is uniquely positioned to evade. While hardware giants like Nvidia and TSMC face immediate threats from potential trade wars over Greenland and tightening export controls, government-mandated restrictions on shipping sensitive technology to specific countries, ServiceNow's cloud-based workflow model carries zero physical supply chain exposure. It is the beneficiary of resilience at a premium. As the U.S.-China trade relationship fractures, corporations are pivoting from global efficiency to domestic automation to offset rising labor costs and a 4.3% unemployment rate. This social shift toward AI-driven productivity software is no longer optional. It is a survival mandate. The lab sees the 8.8% rally today as the market realizing that in a world of physical choke points, digital infrastructure is the only safe harbor. now reported earnings per share of $0.97, missing the Wall Street estimate of 0.97 by 0.3%. A miss that raises questions about near-term guidance. Now is trending higher, currently at $103.42. ServiceNow's press release this morning called it a breakout quarter for AI-driven workflow automation. But let's start with the only number that matters. Insiders bought 6,267 shares in the last 90 days. That's not a buying spree, it's a cautious top-up. When executives are nibbling instead of loading up, they're signaling confidence in the story, not the stock. And the story? A 0.3% EPS miss. 97 cents actual versus 97 cents expected isn't a miss, it's a rounding error. But Wall Street treats it like a margin call because the real story is buried in the R&D line. $3.0 billion, 22.3% of revenue, up 16.4% year over year. That's not efficiency, that's a burn rate. Management is spending faster than the top line is growing, and they're papering it over with AI demand language that sounds like a hockey stick forecast but smells like a pipeline stall. Here's the PR decode. When ServiceNow says AI-driven workflow automation, they're not selling software. They're selling a narrative that AI will outrun their R&D spend. But the 10Q risk factors would say the quiet part out loud. Customer consolidation, pricing pressure, and the fact that every competitor is now an AI platform. The institutional holders, 88.1% of the float, are buying the story, not the silicon. And the silicon? It's still a SaaS company with a 22% R&D tax, trying to out-innovate its own margin compression. What management is saying is, we're leading the AI workflow revolution. What the lab hears is, we're spending our way to relevance before the market realizes the moat is drying up. The momentum breakdown for now. RSI sits at 67, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. ServiceNow is attempting a high-stakes pivot from a workflow engine to an AI-native operating system. The cup and handle formation, a bullish chart pattern where price rounds out a bottom before a brief consolidation, signals a momentum shift as the MACD, moving average convergence divergence, a trend following momentum indicator, confirms a bullish crossover. The massive call volume at the $100 strike suggests the market is betting on the new product cycle to offset the 61.6x trailing P/E, price-to-earnings ratio, measuring how much investors pay for each dollar of profit. But here is what breaks the bull thesis: the triple threat macro environment. While the software is intangible, the hardware it runs on is hitting a wall. If trade protectionism spikes the cost of H100 GPUs, high-end graphics processing units used for AI training, ServiceNow's margins will compress as their infrastructure costs balloon. Microsoft is already weaponizing its vertical integration to undercut them. A forward P/E of 20.6x assumes flawless execution, yet any delay in AI feature rollout makes them a target for seat count consolidation. The question that makes the room go quiet is this: can ServiceNow maintain its resilience premium when the underlying hardware cost per token, the price to generate one unit of AI text or code, is rising due to geopolitical supply chain friction? Our answer is no. Management is pivoting to platform growth language because they see the per-user seat model commoditizing. They are trying to outrun the hardware bottleneck by adding features. But if the Fed stays hawkish, that 61.6x trailing multiple becomes an anchor, not a sale. The lab's AI score of 63 reflects a wait-and-see stance. Watch the $103.42 resistance level, the price point where selling pressure historically outweighs buying. Unless ServiceNow breaks that ceiling with high volume, this is a trap. We are neutral until the engineering costs of their AI roadmap stabilize. Stay disciplined. Lab score, 75 out of 100, strong buy. Nvidia's H100 GPU dominates AI training with 3 terabytes per second HBM3 memory bandwidth, a 50% leap over competitors. Wall Street ignores how TSMC's CoWoS packaging limits supply, creating a 12-month demand backlog. This isn't just GPU demand, it's a data systems bottleneck favoring Nvidia's vertical control. The data teardown reveals hidden margin expansion from in-house AI silicon integration. Nvidia's dominance is currently anchored by the 1.8 terabytes per second. That is the interconnect speed provided by NVLink 5.0, the physical bridge allowing multiple Blackwell GPUs to function as a single massive processor. While the market fixates on the $222.32 price tag, the engineering reality is defined by the move to TSMC's 4MP process, a specialized high-performance 5nm node optimized for power density. Each Blackwell die measures roughly 800 square millimeters, pushing the absolute physical limit of the reticle, the maximum area a lithography machine can expose in one step. By stitching two of these dies together using CoWoS, chip-on-wafer-on-substrate local silicon interconnect, which uses passive silicon bridges to link chips, Nvidia circumvents the reticle limit. This architecture delivers 20 petaflops of AI performance, dwarfing the AMD MI300X, which relies on a more fragmented chiplet approach that introduces higher latency, the delay in data transfer during massive model training. The engineering bottleneck has shifted from raw compute to HBM3E, high-bandwidth memory that provides the 8 terabytes per second of data throughput required to keep the Blackwell cores fed. At a $5.4 trillion market cap, Nvidia is no longer just a chip designer. It is a thermal management company. The Blackwell B200 draws up to 1,200 watts of TDP, thermal design power, the maximum heat a chip generates that must be dissipated. This heat wall is the only thing protecting Nvidia's margins. Competitors can mimic the logic, but they cannot easily replicate the rack-level liquid cooling integration required to prevent these chips from melting. Today's 1.33% dip reflects a temporary macro tremor, but it ignores the silicon reality. Nvidia has locked up the advanced packaging supply chain at TSMC. As long as they control the CoWoS yields, they control the global supply of AI intelligence. This price action is a noise floor beneath a structural hardware monopoly. Quarterly financials showing modest revenue momentum for Nvidia. Nvidia's 73.2% revenue growth is currently colliding with a hawkish Federal Reserve pivot that turns capital efficiency into a survival metric. The Fed rate at 3.64% and a 10-Y yield of 4.47% signal that the era of cheap liquidity for massive AI clusters has ended. We see the yield curve normalizing, the gap between long and short-term interest rates returning to a positive state, which traditionally forces a repricing of high-beta assets. With CPI, the consumer price index that measures the average change in prices paid by consumers, at 0.6% YOY, the Fed is quickly running out of reasons to cut rates. This increases the cost of capital for Nvidia's customers. While the lab notes a low 5.5% recession risk, the triple threat of renewed trade protectionism creates a violent repricing of supply chain risk. The geopolitical landscape has shifted from growth at any cost to resilience at a premium as dual-block globalization threatens the fabless foundry model, the manufacturing strategy where firms design chips but outsource production to specialized factories. Trade war fears and potential tariffs are forcing a high-stakes decoupling of the semiconductor supply chain. This move away from geopolitical flashpoints like the Taiwan Strait introduces immediate margin compression. We are tracking specific risks in US-China competition that could restrict access to critical end markets. Socially, the political pivot toward protectionism is no longer a tail risk. It is the baseline. As the market stumbles over tariff uncertainty, Nvidia's minus 1.3% move reflects the engineering reality that moving high-end logic production is neither fast nor cheap. The lab's verdict: geopolitical friction will compress margins before the next technological breakthrough can expand them. Nvidia reported earnings per share of $1.62, beating the Wall Street estimate of $1.56 by 3.6%. A solid beat that signals strong execution. Nvidia is trending higher, currently at $222.32. Nvidia's earnings call script is polished to a mirror shine, every word calibrated to keep the AI halo glowing. Management is selling a story of unprecedented demand and supply chain resilience, but the insider tape tells a different story. Over the past 90 days, executives have net sold 911,732 shares. That's not a quiet sale. That's a coordinated exit. When insiders dump nearly 1 million shares while the stock sits near all-time highs, it's not confidence, it's risk management. Historically, this pattern precedes either a margin squeeze or a demand air pocket. Nvidia's PR team will call it portfolio diversification. The lab calls it a red flag. The EPS beat, $1.62 actual versus $1.56 estimate. Looks like a win, but dig into the R&D spend. $18.5 billion, up 43.2% year over year, now eating 8.6% of revenue. That's not efficiency, that's desperation. When R&D growth outpaces revenue growth by 5x, it signals one thing. Nvidia is burning cash to stay ahead of the commoditization wave. Management talks about long-term leadership, but what they're not saying is that Blackwell's yield issues and CoWoS packaging bottlenecks are forcing them to overinvest just to keep pace. A 10Q would flag this as execution risk and gross margin pressure. Instead, the earnings call glosses over it with vague optimism. What management is saying, we're leading the AI revolution. What the lab hears, we're one bad quarter away from a reset. The momentum breakdown for Nvidia. RSI sits at 56, pointing to bullish momentum, with buyers in control. MACD is currently bullish, with the histogram crossing above zero. Nvidia's bull case rests on the massive H100, the Hopper architecture GPU that uses HBM, high-bandwidth memory that stacks DRAM vertically for faster data access. At a forward P/E, price-to-earnings ratio reflecting future profit expectations of just 19.5x, the market is underestimating the H100 ramp-up. Cloud providers are desperate for these chips to solve the AI compute bottleneck. But here's what breaks the bull thesis: Blackwell. Any delay in Blackwell production due to EUV, extreme ultraviolet lithography used to etch the smallest circuits, creates a vacuum for competitors. Furthermore, export controls targeting Baidu and Tencent aren't just headwinds. They represent a hard ceiling on revenue growth that the CHIPS Act, federal legislation aimed at subsidizing domestic semiconductor manufacturing, cannot offset. The question Wall Street won't ask is, can Nvidia maintain its 3D stacking, the advanced packaging that layers silicon dies to increase density, yields while decoupling from Taiwan? The lab's answer is no. Moving high-end logic production away from geopolitical flashpoints causes immediate margin compression. While the options flow shows a bullish 0.48 put/call ratio, the ratio of bearish bets to bullish ones, management's pivot to resilience signals they are bracing for a fragmented supply chain that threatens their current efficiency. Our AI score of 75 out of 100 reflects high conviction tempered by engineering risks. Watch the $235.74 resistance, the price level where selling pressure historically increases. If Blackwell hits EUV hurdles, expect a violent retest of $196.50 support. Nvidia is a technical buy, but an engineering hold. The AI hardware race just hit a new inflection point. Nvidia's 75-point strong buy signal is our highest conviction call today. Is Nvidia's dominance unstoppable, or will supply chain bottlenecks finally crack its lead? Let's debate below. We're engineers, not advisors. This is for education only. Do your own research. This isn't financial advice, and past performance doesn't guarantee future results. Stay sharp. The lab out.